On the left, financial books use accounting rules for investors. On the right, tax books use government tax codes. Because they have different priorities, they disagree on when to recognize expenses or income. This timing gap is a temporary difference. Current tax liability is the cash paid for this year's profit. Deferred tax measures future tax payments or savings caused by today's temporary differences. We use a strict formula: the carrying amount on the financial books minus the tax base assigned by the tax authority. If you have $100 in fully taxed trade receivables, both the carrying amount and tax base are $100. The difference is zero. When accounting values perfectly align with tax valuations, there are no deferred tax consequences to track. Now, look at this setup for a newly purchased industrial machine. Governments often encourage investment by letting companies write off equipment on their tax returns faster than standard accounting rules permit. Let's break down the math step by step. Step 1 is finding the carrying amount. The machine cost $150, and our financial books show $50 of accumulated depreciation. Subtracting $50 leaves us with a carrying amount of $100. Step 2 is determining the tax base. The tax authorities allowed a larger deduction of $90. Subtracting that from the $150 cost leaves a tax base of only $60. Step 3 is identifying the gap. Subtracting the $60 tax base from the $100 carrying amount isolates a temporary difference of exactly $40. Step 4 asks what this gap actually means. By claiming that larger $90 deduction today, the company leaves fewer available for tomorrow. When this machine generates future revenue, the tax payments will be proportionally larger. Step 5 puts a price tag on that future burden. We multiply the $40 temporary difference by a 25% corporate tax rate, giving us a $10 deferred tax liability. Front-loading tax deductions shrinks your tax bill today. The accounting rules require you to recognize that you have an obligation to pay those deferred taxes back in future years. Let's examine the opposite scenario. We start with a $100 accrued warranty expense recognized on the financial books. You know the product will break eventually, so the accounting rules record the $100 liability right now. But the tax authority refuses to allow a deduction until the warranty claims are actually paid out in cash. That means the tax base for this liability is exactly zero. Because the company waits to claim this deduction, its future taxable profit will drop when it finally pays the claims. This leads to smaller tax bills later, which we recognize as a deferred tax asset. IAS 12 is centered on these timing differences. Accelerating your deductions results in future liabilities, while delaying them results in future tax assets. Now let's test your understanding. A machine costs $100. The carrying amount is $80. Accumulated tax depreciation is $50, and the tax rate is 30%. Does this create a deferred tax asset or liability, and for exactly how much? Here is the step-by-step breakdown. Step 1. We know the carrying amount is $80. Step 2. We calculate the tax base by subtracting the $50 in tax depreciation from the $100 cost, leaving a tax base of $50. Step 3. We subtract the tax base from the carrying amount to find a $30 difference. For Step 4, we recognize that because the asset's carrying amount is greater than its tax base, we have a taxable difference. Finally, Step 5. Multiplying the $30 difference by the 30% tax rate gives us a deferred tax liability of $9. Take a look at this cheat sheet matrix showing how these balances interact. For assets, if the carrying amount is greater than the tax base, you get a liability. If it's less, you get an asset. For liabilities, the logic simply flips. Current tax is strictly Tabee's check to the government, while deferred tax is the accounting for future adjustments using this exact matrix.